Okay, I think we're ready to go once again. So my name is Kristian. I'm CFO in Trifork. Now I'll take you through the last couple of years, so since the IPO and how things have developed. Jørgen already revealed some of the information that I will also go through, and then I will go a little bit more in details. I will also look into the future in relation to our investments and how we have our strategy of investments and how to allocate capital. So first part here is really how we see the growth, the inorganic part of growth in the company, plus that we're looking into our investments into Trifork Labs. Overall, if we're looking into capital allocation, then we have 5 main areas. We have organic growth, we have M&A, net debt management, Trifork Labs, and shareholder distribution. I'll walk through more details in each of these areas, but what we have talked about until now is primarily related to organic growth. So organic growth being the first priority in relation to our business development, meaning we invest in talent, we invest in workforce, we invest in locations, we invest also in components, product development that we use when we build the solutions to our customers. M&A, I'll dive into that a little later. Net debt management is also, part of the top 3 priorities in the way we allocate capital. Looking over the 3 last years, in total we have invested 44 million euros in M&A. We have partly financed through debt financing of 23 million, and we have invested 21 million in Trifork Labs. Just for you to get the picture of how big are the different investments in relation to M&A versus labs, etc. I'll come back to the larger and smaller components in each one of them. But also we paid out 24 million euros in dividend to our shareholders. So we hope they're happy for that. Looking into M&A, as Jørgen showed you on one of the first slides, we have M&A as a natural part of our business development. If we look back historically, then just about 1/3 of revenue growth has been inorganically, so coming from M&A, where we found new partners to be part of the Trifork ecosystem. The way M&A plays into the overall growth and the target for growth midterm, the 15 to 25%, is that we guide on, or we have the target of 10 to 15% organic growth and remaining part being inorganic. As you see here, 1/3, as I said before. What we have seen is that, and what we have talked into in the many last quarterly presentations throughout 21, 22, and also 23, especially 22, 23, is that it's been a hard environment to invest in, to get new partners into the Trifork ecosystem. The valuations of companies in 21, 22 was extremely high, and we only did a few investments in relation to new companies to join the Trifork group when we found the right match in between the companies and the valuations. What we see right now is an environment where there's more consent in between the company valuations of new companies and the price that we think is the right price as well to invest in the companies. So we do see an improved environment for doing more M&As in the future compared to 21, 22. The companies that we have invested in the last 3 years account overall to 28% of the growth in the Trifork group. The number of transactions we have made is 11. That's including also NCI acquisition. So that is also a natural part of the Trifork group. And since you could say new companies and discussing valuations of new companies and agreeing to that, has been a little harder in the period that we're talking about here, then it made more sense to us actually to also acquire NTIs in existing companies, meaning it doesn't bring in additional growth, inorganic growth, but it does consolidate when looking into the profits belonging to the shareholders in Trifork. All in the period, then key numbers in relation to the new acquisitions is what you see here with multiples on revenue, EBITDA, and EBIT. So that's the range that we have acquired new companies into the Trifork Group. All, when we do investments, we have what you see here, different ways to finance the acquisitions. It's a free cash flow in the Trifork Group. I'll come back to that. It's treasury shares as part of payment, because when we acquire, it's not only to get a new company in, but it's just as much that we also embrace the founders coming from those companies to be part of the Trifork Group. And this we can do by also adding them as shareholders in the group. We have been financing through proceeds from Labs exits as well. So I'll also go through that in a little later. At the IPO, we did a capital increase of 5%. So part of the financing also came from that part. And then bank financing is the last part. When we're looking into companies, new companies to join the Trifork Group, then we look into this from you could say, an ideal target. So when looking into this, what we would like to join into the Trifork Group is really when we see a company that leans out, creates mission-critical solutions, that is a front runner within a niche area. Because then we believe that they will have knowledge, they will have deliveries that companies need, even if we are in a downturn period. We also look into the strategic match with the existing business areas in the Trifork Group. And we are looking to the capabilities that they have in the company. Meaning that either it could be to extend capabilities that we already have in the group, but maybe in a different geographical region, or it could be that it's new competences that we don't have, but we need, because we can see what the customers are asking from us in relation to the solutions that we need to develop is something new. So then we can add those capabilities into the Trifork Group. But it's very important that we have a cultural match, that the DNA, the way that we operate in Trifork, is also met in those new companies adding to the group. One part of that is that what Jørgen talked into earlier is really related also to the size of companies and how they operate, because the business units that we have, in order to create, to keep the creativity and innovation in our business units, we believe they have to be small. So if we do any larger acquisitions, then it would always be when we have identified that the business actually can be divided into smaller business units. So 100 people, most likely that will fit into 3 different business units when we do M&A. When we identify the targets and say, okay, I mean, here we really believe we have something, really see a match here, then what do we then do? Then we look into the track record of the companies and match that with our future ambitions, match that with our synergies, potential synergies that we see from this new company joining into the group. We typically will not look into companies where we have a founder that actually want to exit, they want to leave the company, because this is really not in our DNA. What we would like to do is join founders, just like Cedric. So super happy for him to be here today. I don't know where he is, but oh, over there, yeah. So super happy for him to be here today, because that's exactly what we would like to do. We would like to form new partnerships with new companies that bring in more energy, more new learning into the group. So it's really about, for Trifork, that we create a home for the founders to be in a larger ecosystem and to exploit what we already have in the Trifork Group and to feel at home, you could say. So we'd like the energy from the founders to be released in the Trifork Group, so to say. And then what we do is actually that we initially, most often only acquire 60 to 70%, because we still want everybody to have kind of like blood in the game in the initial phase. But then when we get to know each other a little more, then maybe it's not so important anymore, because maybe a founder will find a replacement for himself and move on to do something else in the Trifork Group. And then that's the time where we then acquire more minorities typically in those investments, and that's the way we think and the way we act in relation to this. Overall, we believe that both founders, sellers of the companies, when joining into Trifork Group, will have an opportunity actually to gain value, as well as Trifork has an opportunity to gain value being a larger company and a listed company. So now I will introduce you to one of the very early companies that joined the Trifork Group back in 2011. I have Francesco here. And as said, 2011 is a long time ago. Francesco was the founder of the company. He's still around, and we're super happy for that. So maybe Francesco, if you can take the word from here.
Yeah, thanks. Right. So good afternoon, everyone. So I'm Francesco, the founder and technical director of Erlang Solutions. I can't say I founded the company in a farmhouse because there were no farmhouses in central London. I didn't found it in a garage either because I didn't have a driver's license at the time. I ended up founding it in my bedroom because room space is so expensive in London. And the year was 99. I slowly kind of then brought on a business partner. And in 2008, we saw the financial crisis arrive. And we decided to sail the ship straight into the storm. Literally, we ran an event in Palo Alto, in San Francisco, outside in California, where we found a lot of new customers. We did so by maxing out our private credit cards because the banks wouldn't give us any credit, and really came out of it strong. And it was, I think, 2011 when my former business partner decided that it was time for him to move on and find new challenges. So he decided to sell, and Trifork was the perfect partner to come in and acquire us. And in fact, I think there was a slide where there was a little orange person standing on a stage. That's how we came in contact with Trifork. I was one of the subject matter experts speaking at conferences organized by Trifork, and that's how we got to know each other. So there was a perfect match and a perfect DNA, and we complemented each other very, very well. Today, I think we're a total of 6 business units, 5, so they're spread across Europe and in the Americas. 5 are running under the Erlang Solutions brand, plus we've got a 6th business unit called 7th State, which I'm going to talk about a little bit later. Now, I think a lot has to be said about the pandemic, but the pandemic was really good to us. It forced us to become a remote-first company. And, a remote company. I think it forced everyone who had that ability to start working remotely. But in our particular case, we took the decision early on to keep on being remote even after the pandemic. And I think we took this decision in the management team in August of 2020. And I remember I'd fled London from Italy, who was taking COVID a bit more seriously. And obviously, we had no childcare. So I was taking the management call by the Trasimeno Lake in Umbria, where we were working from. And the CEO at the time asked, should we remain remote even after the pandemic? And pretty much everyone said yes, absolutely. And being remote has really helped us because our biggest challenge was staff acquisition and staff retention. And by becoming remote, all of a sudden the world for us the world basically was became possible to hire people anywhere. And in fact, if we look at it today, we're 134 permanent employees plus, give or take, we've got a large pool of subcontractors which we take on board. We've got 23 nationalities living in 25 countries. We have even people working in Japan, cut out of the map here. But not only that, our staff attrition rate, as a result of it, is now down to 6%, which is something I'd never experienced. By being able to recruit people during the pandemic, it had taken us 20 years to reach the state where we were. In 18 months, we were able to double in size. And we were able to double in size, we were able to increase our margins because we didn't have a lot of the overheads. And staff attrition, really took a nosedive, which in this particular case is a good thing, to 6%. So, it was an incredibly rapid expansion when becoming remote. And it also helped that the fact that we work with back-end infrastructure. So what we do is, Preben was talking about the visual surface. Julie was talking about the user experience. What we do is everything which doesn't have to do with the user experience or the visual surface. We do basically what they're talking about is the tip of the iceberg. We work with the software which is under. It's the software which feeds the Visual Pro all of the data. It's a software which gets all of the telemetry or all of the data from the diabetics and pushes it to a database, which is then used to serve the data to good-looking applications on the iPad. So we're almost the kind of the unsung heroes. No one knows that the software we've written is there until it fails. And then at that point, yes, that's when everyone starts pointing fingers. But the good thing is, we've taken inspiration from the good old telecom world. So we're using a programming language which was developed to build telephony switches. What's a telephony switch? Well, you pick up a phone, you'll always hear the toot on the other end. Think New Year's Eve in the 80s and 90s, at midnight, millions of people picked up the phone and called each other at the same time to wish each other Happy New Year. And your phone call got switched, it got through, even though there's a huge surge. Now, this was the 80s, in the 90s. Using those ideas and using those concepts, pretty much any system connected to the internet today has to display those characteristics. And so we take those ideas and concepts and apply them to kind of fintech, to blockchain, digital health, IoT, e-commerce, messaging, and many, many other solutions. So as an example, when WhatsApp was, when they were still a small company, they still didn't even have an office, but they were expanding incredibly rapidly. They called us because they were having downtime issues. MasterCard, Vocalink, we helped them implement a faster payment switch, which allow you to make instant payments from one bank to another. Remember the days where it took 3-4 days to do. Klarna, the Pay Me Later service, which is now a bank. Again, a lot of checks, going in. Is this fraud? What's the credit rating? And off they go. T-Mobile, we built their whole SMS gateway, which got in massive of votes in very short, massive of SMSs in very short periods of time. When you had TV shows, take Grindr, we did their whole messaging solution with millions of messages being sent every day. And I think what all of these systems have in common is that you're switching phone calls, you're switching SMSs, you're switching video streams, you're switching stocks, you're switching money. The business logic is still the same. And it's exactly the same concepts and ideas. What changes are the requirements of speed. If you're switching stocks, you need to be very, very fast. You're switching money, you need to be fast, but not as fast as a stock. You're switching, a WhatsApp message. Yeah, it's okay if there's a few seconds lag. And so, so that's what we do. If we look at where we are with the future, I think our largest expansion post-COVID has been in the US. We've got an amazing Americas team spread across Canada, the US, Mexico, and all of Central and South America. And they've mainly been working with digital health and e-commerce. So we've been building massive e-commerce sites for our customers. And looking at the future right there, what we're doing is we're building kind of the convergence of IoT and machine learning. So how do we pair the two together to start building, I think, many of the systems we've heard about today? We, as a company, we also are spinning off brands and products. So I mentioned 7th State. What they do is they're a messaging bus. They're a glue between systems, which allow you to integrate systems which are not necessarily compatible with each other. So they basically are at the core of these systems. And we've spun it out. We're telling them, grow up, leave home. It's time for you, to get your own life. And we believe that this expansion will help them grow much, much faster. We've got a lot of internal products as well, which security scans of codes, monitoring tools. We've got our own messaging server. And all of these products we've built for our customers, but we've retained IPR, so we're able to go in and reuse it where possible. And again, when the opportunity arises, we'll be asking them to move away from home. Just like the rest of the Trifork group, we're expanding organically and through mergers and acquisitions. And one of my, for example, primary tasks right now is to try to get a business unit off the ground now in the DACH region, so Germany, Austria, and Switzerland, focusing again on what we do. And so this is us. And just to wrap up with events, events are also here at the core of what we do, just like Trifork, just like we heard Jörn earlier today. And it's basically what drives innovation, kind of market intelligence, but it's also a way for us to showcase to our customers, I think, all of the work we do. So that's us. And I think 30 years on after having founded the company and after 12 years within the Trifork group, I think we're still seeing ahead because there's so much more work which needs to be done. Yeah.
Thank you. Thanks. And we hope that you stay on for many more years to come.
We've got work to do.
So now you heard the story from one of the companies joining Trifork. I hope that Cedric, maybe next time, you can tell your story, how it was to join the Trifork family and be part of what we do. And maybe you will, be somewhere else in the organization. I don't know. Let's see. Okay. So now we kind of looked into the first thing in relation to M&A. And of course, I'm the financial guy, so I have to talk into numbers as well. So I will do that. Now I'll focus a little bit in relation to Trifork Labs. So as you know already, we have the two overall segments in Trifork, the Trifork segment and the Trifork Labs segment. As we talked about until now, in the Trifork segment, we really focus on have a stable growth, solid margins, and have control of the business to minimize risk. Organic growth focus primarily, but also some inorganic, as we just talked about. Then in relation to Trifork Labs, what are we focusing on there is what Preben talked into. It's R&D. It's this combination in between the Inspire that we have in Trifork plus the R&D in Trifork Labs, R&D coming inside of Trifork as well. But this part of our R&D is not only financed by Trifork, but is also financed by other external investors. So this is where we see, opportunities to create companies, products that actually has a potential of high growth, that can scale up fast, but maybe don't earn as much money in the beginning, so you have to invest. This is why we, from Trifork, don't want to do that investment internally in the Trifork segment, but actually want other investors to join us in increasing the valuation of those companies. I'll talk into if this is a good idea or not. One thing, of course, is all what we get in relation to the R&D part. And this I can say for sure, that's a good idea. We talked a lot into this until now, but I'll also look into, of course, the financials of this. Say, is this a cost center? Is this actually good? Or when you look into the financial reporting from Trifork, then you see us reporting in many different ways. So we try, because I mean, this is a hard material to grasp. It really takes a lot of explanation. So we always talk a lot about this. And today, I think I will give it a little more flavor so that maybe you see more the idea we have around this a little more today. Overall, we present this in many different ways. I'll walk through 3 or 4 ways to look at this, and then you can make your own considerations into this and see if you think it's a good idea as well. So overall, we group our investments into whether it's strategic collaborations, if it's product innovation, if it's digital sustainability, or technology inspiration. So we focus on these 4 areas when we're looking into different labs investment. Overall, it's all related to Trifork being at the forefront of innovation. Another way we show this is that we also focus on the synergies of the investments that we do in Trifork Labs into the rest of the Trifork core segment. This is why we here map, inspire, build, run our go-to-market model with the business areas that we have in Trifork. We already talked into these, and see how does those companies that we're invested in, how do they match into this map? What we also explain when talking about these companies, these investments, is where are they in the growth journey? Where are they? How mature are they as companies? When did we invest? So when did we start the investment? And what is the status right now in the companies? Some companies, of course, you can see self-funded. That might not tell you a lot, because then it could be anything from just started to a company that is actually, a bigger company. But overall, with these different dimensions that we try to give you and place the investments into those dimensions, it could give you a more clear picture on what kind of company is one or the other. Overall, we also disclose here the 10 largest companies in relation to book value. So when we report about top 10 investments, then it's not related to how interesting they are necessarily, but it's the book value that we have in the Trifork Group. Now, as what you see here is that the top 5 is actually 73% of all book value, meaning that if you have limited resource of time, what you should do is then look into the top 5 companies. They are not prioritized in value here, but alphabetical. And if you have even more time, then you can deep dive a little more into 6 to 10 to investigate a little more into those companies. So overall, you only have 7.7% left, and maybe it's not so important to focus on that unless there's a particular new investment that you think this one is hitting a technology that will be the one for the future. Of course, then you should look into that. We provide some additional information with the color coding here. You see by all the different investments. So the ones with the dark orange, that's companies that are profitable, been profitable for more than 2 years, and pays out dividend to Trifork. So that's the more mature companies, solid companies with the good profitability. Then we have the yellow ones. They are companies with a solid investor base, where we have the funding for new investment rounds if needed, already within the existing investors in the companies. Then we have others which has funding for at least 12 months, or where we need to do a new investment round, a funding round for the companies within the next 12 months. So that's in order to give you an idea how solid are those companies that we report on, and what kind of, how do we see those companies in relation to risk, if you look into that as well, and to see if there could be a potential capital increase in companies, etc. Here, just to show you, we are working with a lot of international investment funds when you could say at the later stages in the companies that we're invested in. And we have a solid network of investors that we tend to work together with for more than one investment. And we always go back when we have a success and then try it again one more time. Looking into the different top 10 customers, investments, I mean, we cannot disclose information related to individual investments, but what we can disclose is the total revenue from all the different investments that we invested in. So in the top 10 here, you see that in 2023, all revenue was 72 million in the top in total in the top 10 companies. That, of course, we don't own 100% of this, so none of that revenue is consolidated in the Trifork Group. So this is just for your information to have a look, say, okay, I mean, how solid is this portfolio of investments in these companies? What we also see here is that actually the revenue grew 46% last year, from 22 to 23 in the same 10 companies. So that's why we say, okay, these investments are high growth and focus on high growth and not necessarily in relation to profit margins. If we take our ratio of ownership to the companies and say, okay, but how much, if we consolidate that, would actually then be part of Trifork, then we have some small numbers, of course, because we don't own everything. And we see that the average increase is 33%. So still a very nice increase in size of business. Then looking into profitability, and this is maybe even more interesting, because, as I said, I would not necessarily expect this to be a profit. Maybe it will still be cost and burning money. But what we have worked with the companies on for the last 2.5 years is really, there was a frozen zone in relation to investment from capital funds into early stage companies. So we advised all the companies and worked with them in relation to find a way to have a high growth target budget forecast, but also a more sustainable forecast. So we actually advised them to maybe hold back a little bit, but then have a way to get profitable. All what we saw then here is the development from 22 to 23 is actually from having a minus of 1.2 million, it actually came to a profit of 9.9 million in 23 in those companies. As said, once again, unfortunately, we don't own all of the companies 100%. But when looking into our ratio of ownership in the different companies, then we came from a minus 1.5 to a plus of 0.2 in the companies. So from my point of view, I mean, I'm happy with that development in the companies, showing that actually they were able to leverage or to level out and be able to support themselves for a longer run rate. Here's really a busy table, but what this table shows is actually all what I just explained. So it has all the information on the 3 different slides just in one table here. And this we use in our financial reporting, so you can always go in there and you can see, why did Trifork invest? Was that because of a strategic collaboration, technology inspiration, product innovation, or digital sustainability? What business areas is this supporting? When did we enter into the company? How much do we own? What stage is the company at? And then also here, when talking about valuations and the book value, when was that changed the last time? So you got to get a lot of information in this table. As you also see here, then I will talk into the method that we use in the book value valuation in our financials. You have then a link to the different companies' own web pages where you can get even more information. So it's just all about deep diving into this table and then look into top 5, potentially top 10. Then you get a lot more information. The way that we approach valuations is 2 ways. So we're looking into the companies if they are profitable or not. As said, if they're profitable and have been profitable for more than 2 years and start paying out dividend, then we switch to a DCF model valuation of the companies based on the latest forecast, the actual results, etc. And then together with our auditors, we approve a valuation for the individual companies. The companies that are not yet profitable, then we do reassessments. If the value is to go up in our books, then there has to be an external financing round where a new lead investor, which is external from Trifork, is taking the majority part and is putting the price tag on the company. That said, we still would like to say that we are conservative, meaning that if we have a company that did not have a financing round in a period, but do not follow the expectations that we have in relation to the budget, forecast, or development, then we would assess and make a risk assessment of that company and see if we need to write down some of the value, even if we haven't had any new investment round. So this we would then do some impairment if we believe that they are not following the track that we expect them to follow. Here's some more information, more in relation to, so you can see it's not that we just have one pile of money that we put into every investment. It's quite different compared to what kind of investment that we go into. Now, as you can imagine, then if you go in very early in a company and invest in a technology, then maybe the ticket size is not so high. But if you go in later, then the ticket size might be higher. But for some reasons, we could say we would also like sometimes to go in higher ticket sizes when it's potentially strategic partnerships where Trifork not only is investing into a technology, but also see the value of that technology bringing into Trifork. Could be a collaboration with a customer of Trifork, where we together build technology that the customer would use himself, but also would be sold to other companies. So what you see here is that it ranges from almost 5 million euros and down to almost nothing when you start a new company. Average, it's 0.9 million, but as said, average in this case is very, very different from investment to investment. So, as I said before, we've seen in an investor or venture capital environment for the last 2 years, where it's been more or less frozen in relation to get interest into new companies. If we're looking back in time, and if we look at the technologies that we invest in, then we believe there is a time for every technology. And it's also important that you maybe leave some of the technologies behind when we are going on to the next step. So based on that, it's very natural for Trifork at some point to move out of investments and continue with something else. So it's a natural process for us actually to have exits. Sometimes it could be exit the whole investment in one go, or it could be you could say a partly exit over a period of time. And of course, as Jørn is always teasing me with the analysis, so I need to have those socks, Jørn. But of course, I mean, that's because we decided we didn't want to continue in this space. It was a little too much sunglasses and beard, but now we're almost there. But so of course we need to exit when we find that this is the right thing to do. Yeah. So what is going on in the future? I mean, what we see right now is more appetite in the investment environment of venture capital. So we do see opportunities. The last 2 years didn't see a lot of external financing round. So that's also what you have to have in mind when looking into the book value, of course. But we see more interest inbound, looking into some of the companies that we are invested in, etc. And we do believe that within the next 2 to 3 years, most likely we'll see an exit or two or partly exits in this space. Now back to the financial part of this, because I promised you to look a little bit deeper into this. And looking at the book value, so the 71.2 million, that's up to here. So that's the book value in Trifork. So this is orchestrated by cash investments. That's the 17.8. It's the investment from unrealized gains from deconsolidation. And one of those investments is coming up here and presenting about the company very shortly. So that's when we grow a business unit inside of Trifork, which is consolidated. And we find out together with the co-founders that actually maybe by adding additional capital to this business unit, they could grow even faster. They can grow even more value. Then we will support that. And then we deconsolidate it. And of course, in the Trifork core business, then suddenly we take some revenue out of the core, and then it makes our life harder in order to meet the revenue targets and the growth targets. But we believe in these cases, and the reason because we do it is that we believe we can generate even more value in this accelerated growth path. So that's why we do it. So overall, you could say we're thinking about the shareholder of Trifork and see, okay, but how do we grow the biggest value possible here? And if we kept to analysis, then maybe I would not have to explain too much. But unfortunately, we didn't. So what you also see here is then the light blue here is then the increase in valuations based on the current investments that we have, which is unrealized still. So that's how you should read this graph here. And we do this update in all our financial reportings so that you always can follow up on, okay, but actually, how did we do? Did we do any exits, receive dividends, etc.? And how is that going on? So I just learned a new word, value to paid-in capital. I mean, we didn't focus so much about that, but since you're all a lot of analysts here today, then we also wanted to see or show this and say, okay, but actually, are we doing good or bad, or how we're doing? I mean, we are primarily focused on the R&D that we create and the synergies, etc. But of course, we also want to do value creation as much as possible for the capital that we invest. So if we look back from 17, so I would say this two-segment strategy of Trifork started back in 2016. So that's why we don't go back any further. But if we look back there, then in average, we invested 3.7 million euros a year. Net gain in average is then from the business units deconsolidated here, is from the unrealized gains, and then it's for the realized gains. So looking back in average over this period, we actually 4.1x the investment that we did when looking into value to paid-in capital, TVPI. And then I asked Frederick, I mean, is that a good or bad number? Where are we? And then he looked into a lot of different sources, and said, well, actually, this is in top 5% when looking into US and European VC funds. So, I mean, I'm happy to have that number. Now I can share it with you. But of course, these are all numbers in this way. So if you have another way of doing your math, then maybe you'll come up with another number. But this is when we compare things in this way. Not only it's you could say the realized gains, because realized gains in our lab business means that it's cash that we get in hand. So cash that we can reconvert back into M&A or to pay out as dividend to our investors or to bring into new lab investment. But it's also, you could say, the net profits every year, which is impacted by what we do in our lab segment. Oh, it costs roughly about 2 million for us to run the organization behind all of this and to orchestrate all the investments and coach and be part of the investments, etc. Roughly 2 million euros a year. That is reported on EBITDA minus, you see on our Trifork Labs reporting. But in average year, the profits from those investments, they come in on EBT, meaning that if you look into EBT, then you see these results over the years. So an average of close to 10 million euros over the same period on EBT. And now I will hand over the word to Alexander. Alexander is from Dawn Health, which initially was a business unit created inside of Trifork. But some years back, we then decided that we needed to do an even more accelerated growth journey together. So then other investors came in, and now I'm very excited to hear where you are right now and how things are.
Thank you, Kristian. Okay, my name is Alexander. I'm co-CEO of Dawn Health. If you look through the window, you can see our office is right on the other side of the dock. We have blocked our view a little bit by Bjarke Engels, but otherwise we are very close also physically to Trifork now with the latest move they made here. I will speak a little bit about what we are as a company today, also how we have worked together with Trifork, and give some showcases as to some of the technology that we built. If we look at the company from a helicopter perspective, you can see that, as Kristian also alluded to, we were founded in 2016. Actually, we were founded together with Trifork as the majority owner back then. We work in digital health, which I will dive a little bit more into exactly what it is, because it's different from the digital health solutions that Trifork do in the core of their business. But we have a mission statement, which is code to save lives. We do this by having a focus on patients globally. So we work primarily with private life science companies, being the larger pharma companies of the world and the larger medtechs. So in the large market of digital health, you can say that if we divide it into two overall functions, being what is digital solutions that could be consumer products that are unregulated, all the way to the very, very heavy DTX and software as a medical device solutions, we can span end to end in this market. And this is what makes us unique in Dawn Health. But I will get a lot more into that. Over the years, we have launched products in over 20 therapeutic areas. We have launched in over 50 different markets. So our ambition to impact patients on a global scale has so far held true. So the reason why we work with global pharma is that when we make solutions for patients or for HCPs over the world, it's really important to us that when we solve the problems, we solve them on a global scale. Because a diabetic in Denmark will have the same kind of problems as a diabetic in Germany. We want to make the solutions work on a global scale, and this is why we work with global pharma. They have the innovation drive and they have the global reach to make the products span globally. In 2021, we agreed with Trifork that we wanted to move out of being a consultancy business and wanting to be more of a platform and you can say, an enterprise or software provider to our pharma companies. The reason why we did this is because, as some of you may know, a lot of the digital health products that are born within pharma companies, they fail, at least within the private life science industry. So we wanted to help in a much bigger way than just building the code bespoke. And this is the reason why we initiated a funding round where we raised a little over 23 million euro. So what we want to do with this money is build out our platform. We want to increase our capability in the regulated space. When we work with CMD, maybe just to double down on what that actually is when we have software that take part of the doctor's, you can say, role towards the patient. So some of you may already know this, and sorry to repeat the message then. But when we look at software as a medical device, either under MDR in Europe or under FDA in the US or other regulations that we may have, we look at software that can either be triaging the patient's drug, depending on, you can say, information you get out of a connected device. It could be diagnostics, data collection, and so on, that are critical to identifying the disease of the patient. What we want to do with the software that we build is drive behavior change in the real world. So for patients and also for the pharma companies to utilize the values of the drugs they build. Because it's no secret that a lot of the drugs that are being built today, developed today by the pharma companies, they never really seize the same potential in the real world as they do in the clinical trial, because the clinical trial is a closed setting, you can say. So we want to empower the patient to take control of their disease, to get more information, and also to empower both the HCPs and the caregivers around them. To do all of this, you need a long list of certifications, because when you do software that can tell a patient how to take their medication, it can go very wrong. So we have spent the last couple of years and part of the funding that we received in 21 in building out our internal capabilities to be state-of-the-art within our industry in terms of quality standards. And this is something that we are extremely proud of today. So this means that we can, together with our pharma partners, take a digital solution and scale it all over the world, which is in itself something that is very complex, because you have different regulations in different markets, everything from data to compliance. Moving on, I will not spend too much time on this, because knowing that Trifork is also within digital health, this is probably already known information, but the expectations to the digital health growth over the next couple of years is very high, but not only in the US, you also see markets as EU and APAC growing in this scale. So this is digital solutions by and large, which we also do in Dawn Health. But what we are more excited about is the increase that we expect to see within the software as a medical device industry. It is something where the market dynamic is still finding its feet, and pharma, you can say, innovating products for patients is still something that is regulated and complex, but we see legislation also moving in the direction to empower both the patients and the pharma companies. So you see in the graph that the compound annual growth rate expected over the next 5 years, or the 5-year period indicated here, is close to the one for digital health overall. Also, there's a very, you can say, high agreement in the industry that this is something that will have a bigger impact in the future. And the reasons why is listed here in the bottom. It can be anything from market access. It can be price, how you defend your price in the market in patent runouts, in terms of the data that you collect, and so on and so on. So there are a number of these use cases. I will dive into the ones we work with the most. So on the screen here, you will see some of the solutions that we have already built and are very proud of today. So everything from remote patient monitoring, which is the case that I will dive a little bit more into, but also connected health, so connecting with a physical device to give data live to the patient or to the HCP, you can say patient companion apps that really provide understanding for the patient on how to live with their disease and take their medication, follow the prescription of the drug, and so on. We have worked with digital therapeutics, in vitro diagnostics, and also algorithms. So what enables us to do this is that we build the platform for the technologies to get in the hands of patients, which is where the regulation comes in. It's also one of the reasons why the barriers to entry within our industry is very high, and we see very few competitors in the market, because the regulation that is actually required to put the product in the hands of the patient is before any innovation out there. So for clients wanting to work with biomarkers, with AI, any kind of new technology that we see in the market, really it starts with following the compliance of the standards that we must uphold. And this is where we come in. We are the baseline platform for our clients to engage. The way that we operate is that our revenue model is split into different categories. So we have, you can say, a baseline infrastructure, which is a quality management system. I will not go too much into detail with that, because then there will be some nodding heads, I'm sure. Also the IT infrastructure, which is extremely important in working with data, allowing us to share data with pharma or other parties in a, you can say, orderly manner following the legislation. On top of this, we have built our own platform for innovation, which is composed of a number of different software modules that in essence build out the basic application for the pharma companies that we see them use the most. So this means that with us, there's a very high guarantee that the products will actually go into market. Some of the products we have been working on before making this investment could take 4 or 5 years before they actually reach the market. Last year, we launched products within 5 to 6 months. So the reliability that our partners can have in us to actually bring the products to market, the way that we can work with them in a way that they see transparency over their portfolio, is something that we know they value a lot. Obviously, we operate and maintain the products once they're in the market, and on top of this, we then scale the licenses. So moving into becoming a licensing business, we work with a foundation, which is you can say, the enterprise structure for our clients, and really they add on top of that in terms of data reporting or market rollouts and so on. If you look at the most common use cases that we work with, you can see that we worked primarily in 3 overall buckets or cases that we work with our clients in solving. This could be improved drug performance, as I mentioned before. It can be retention of patients, or it could be market expansion. So when we look at a drug going into the market, what we call phase 4 or the real world, after the product is in market, we often see that the product will not perform up to the standards that it did during the clinical trial. So what can we then do to either uphold the pricing that the pharma company have negotiated with the payers, or just to deliver, you can say, the consumption of the drug as expected, is that we can educate the patient by doing patient support programs. It could be symptom tracking and so on, which is the case that I will dive into. We also see retention of patients, so not understanding how to take your medication, not understanding your disease, not having access to the specialist that maybe need to treat the disease that you have is something that can make you drop off the medication. Having side effects is also something that normally makes you, how can you say, drop off the medication, especially when we work in rare disease. We see that it can oftentimes be invasive treatments. And then finally, looking into the market expansion cases, we see that a lot of times we see public data that there is treatment inertia with the HCPs. So an average HCP in Denmark, for example, will have around 10 to 15 minutes with a patient, treating up to 800 diseases a year, and will not be an expert in all of the diseases that they treat. So digitalizing these guidelines can really help empower the HCP to have the right conversation with the patient, and especially when it comes to diagnosing invasive medications, it can help more medication actually go into the market. So these are some of the areas where we work the most. If we then look at our case with Novartis, where we are working with them on a global scale and across a lot of their treatment areas, what we did originally was help them embark on our platform and working specifically with the case around MS or multiple sclerosis. So the case for multiple sclerosis is actually twofold. It is both in terms of market expansion, but also getting the patient to actually adhere to the medication that they take and putting them in contact with the HCP. So if a patient today is diagnosed with MS, normally they will be put under surveillance for a period of up to a year. In this period, they are asked to monitor their own symptoms and doing so in their own home. When they monitor their own symptoms, a lot of times they will either write on a piece of paper what they have experienced through the year, or they will maybe have a caregiver go with the doctor or go to the doctor with them to explain. What we have tried to do with Novartis is using the smartphone for the patient to actively and passively get data collection that they can then leverage together with the HCP, so that the HCP knows exactly when they need to act to get the patient on a higher treatment dose. This same platform we have scaled across a number of treatment areas within Novartis, so leveraging the same software and the same platform, they are able to roll out across all of their disease areas in a very effortless way, increasing our license with them and our stickiness, but at the same time also getting them to market with a lot more digital solutions. On a graph, you can see here in a very simplified way that normally when we engage with a new client, we go in the first year, focus on one disease area, and then we scale across a lot of different disease areas. There's very long stickiness to our licenses. Normally we see them being tied to the lifetime of the drug or a minimum of 6 to 8 years. We have a very high cross-selling opportunity and we have a very high upselling opportunity because there are very few partners who have done this well with pharma today. Being able to get in there and actually get the products in the market is in itself a unique trait. I think I will conclude here and pass the torch to Jørn, and thank you so much for listening to Dawn Health.
Thank you, Alexander. Just a few questions for you.
Yeah.
And comments. So this is just one lab company, and I hope you can see that it goes deep with a lot of capabilities, with a lot of know-how. So when we met Daniel and you, we did not know a lot about regulated software. And what you also showed, but you didn't say it, but I will say it, is that there is another lab company, Exceed Health, that actually is a spin-off from Dawn Health. So not only do we have a really good lab company here that taught us about regulated software, but it also spawned out a company that actually taught you about regulated software. Exactly. Because they were the first product, the Exceed. So this is how the ecosystem works. And all this ties into our digital health strategy, because when we are at a customer, maybe a government, we can say we have access to these capabilities as well. And when we then meet a life science company like Novo or another one, we can say that we know how it is to work in life science, even if we want to fix your SAP system. So that's another synergy we have here. And finally, about the US expansion, we also align on this. So we coordinate very closely how we get into the US, because it's not just about technology, it's about tax laws, labor laws, the whole thing. When you move into a territory like the US, it's really complex. So we help each other with that expansion. So, and you sit just over here.
Yes.
So you have half of the second floor over here. And I sit at the board. I'm very happy to sit there. It's a really interesting journey. And I think it's underestimated what this can become. It's always hard to grow a business. You will probably sign that. Yes. But it can be very rewarding, and I'm sure it will. So thank you so much for coming.
Thank you.
Okay, so I know now maybe you have a lot of information in your head, and now we get to the financial review. So this time it's not like a quality reporting, but it's more focusing on, once again, a period since the IPO in relation to performance and targets. So I will go through some of those numbers, and then in the end, after this presentation, we have a Q&A session, and then if you have any additional questions, then we'll come back to that. But as said here, we'll look back into the last three years, and then also put a little more words into the targets that we put for the future. Overall, Jørn already talked into this, so I'll not use a lot more time here, other than saying that this more or less was on purpose, and especially within 23. So already in 23, we saw that the business environment was getting tougher and tougher, and we decided early on that we start to invest into the future growth, and starting in 23. But I think Jørn talked a lot into that and say, well, it does take some time, and it does take the right people. We believe with Morten and with Karen, it's really a good, solid combination. But of course, it's not them who has to do the work. It's all the people throughout the organization that actually has to succeed with this in the day-to-day business. But we did invest more, and did see some declining margins on adjusted EBITDA in 2023. All Jørn already talked into this, so I will not use a lot more time, other than saying that in the current guidance we have for 24, you do see that we are a little hesitant in relation to the growth, organic growth as well. So we only guide the 5 to 10% growth organically in 24, with the reason that I just talked about before. In relation to acquisitions, then it's still the midterm target for us that we grow the 15 to 25%, including acquisitions. And of course, that's always hard to translate directly into one specific year. I mean, how much would that then be in one or the other year? But as we talked about before, what we saw the environment in 21, 22, it was really hard to do acquisitions where we thought there was the right combination in between profitability, growth, and pricing, etc. But this is something where we see that the match is there now, and we believe that we have even more opportunities in the future. It's not because we didn't work on doing anything and didn't work on that for 2 years. That's not the case at all. But we had to say no in a lot of the discussions that we were in. Or if you break down, you could say, or make a bridge in relation to where's the growth coming from overall, then Run is the growth driver in relation to the organic growth. So all here you have a CAGR of 25% in Run over the period of 3 years, which for me and for us is a good thing to see. When we're looking into even I will come back to that. So it's good for us actually to grow that part of the business. But still, we also have a solid organic growth in relation to our build-based revenue. Inspire is a separate talk, you could say. We do Inspire primarily for all the reasons that Jørn talked about, into finding the right areas to be in, to be on the edge of technology, to know what's going on out there, to know when companies are ready to adopt the technology. So it's still super important for us. But as you know, it's been struggling during COVID with no conferences, etc. So hopefully we'll make this work again soon. Growth in relation to different companies. Jørn briefly talked into it when you saw the world map with all the different areas that we are working into. We saw that in 2009, Jørn moved to Switzerland because we were primarily at that point in time engaged into fintech and fintech customers in the Danish market. And this financial crisis was not, I mean, then we would have wished that we were, maybe in digital health at a point in time, but that was not possible then. So that actually caused us to move out and to focus more internationally and globally. So looking into this period, once again, and see the development here, is that we did a solid organic growth in Denmark, 19.1%. But actually, outside of Denmark, we saw a growth of 28.1%. But of course, you could say the base was lower, meaning that the impact on group revenue wasn't that high. We saw one market declining when we did the IPO. Actually, we had the Netherlands as one of the focus markets, if you remember back then. But this now has been replaced by the US, where we see a lot more opportunities. So it's more like where is it? It's also the easiest to grow markets, and we believe that US is a better market to grow in than in the Netherlands. So growth moving forward. We already talked into it, and what we showed in the graphs is more or less equal to a 5% average inorganic growth until 26. I mean, will that happen? That, of course, once again depends on us being able to close deals with new companies and to bring more engaged entrepreneurs into the Trifork family. But we are working on this. We still believe that Run will be growing the fastest organically. We don't see that we will do a lot of acquisitions within Run. It's often very expensive to buy Run-based revenue. So most often we will buy into build-based revenue. But once in a while, we can actually make that happen, and I will talk into that as well. In 26, so looking ahead a couple of years, of course, this is a very, very tough slide to build because I cannot predict the future. I don't know if the business environment that we have right now is going on for how long, or if it's going to be even worse, or if it's going to be better. I know some in the European Bank, they're talking about lowering the interest rate. Maybe that will ease up something, I don't know. But there is a lot of uncertainty still in the world. So what we have chosen to do is, because all our investors are asking, but increased margins, what is that? I mean, where do you want to be? What is your ambition? What is the target? So what we are saying here is that, I mean, now we're out with the new guidance for 24, and that's the guidance. And I mean, that was a downgrade compared to where we saw it initially. So what we believe now is that even if in a slow market, if the market stays like it is today, we believe that we can optimize our business, that we can improve margins, even in conditions like today. But of course, if conditions get even worse, then we will also be challenged. But we do believe that we have some handles to pull in order to improve the business anyway. If the market recover, then we also expect that we will follow the market. As Karen talked into when talking about US, I mean, we really do see a lot of opportunities. But the hard thing there is really to see when it's really materialized, because all what you will experience with Vision Pro today is something that makes you, see a lot of new potential, see a lot of new ideas, etc. And initially, it would be, something that you have to prove. You need to make a showcase. And then afterwards, when you have to combine all the data that you have in the company, and when you really can make it, you could say, advanced solutions, that's where the bigger engagements will come in. And this is where it will trigger profitability for us as well. So when that is going to happen, and within slower or market recovery conditions, that's too soon to say. So what we did in 2023 and now in 24 as well is that we invest in our organization. We invest in business development. We invest in coming up with the new innovation ideas. We invest in, for example, on Vision Pro, actually to build a platform so that we have our own platform that we can license in future Vision Pro solutions and then onboard customers to a core platform where it's so much faster for us actually to deliver the solutions to the customers. But that's investments that we take in the organization. So when talking about the 5 pillars, these are investments that goes into organic growth. And these investments, of course, initially would impact the build-based business at first. When the products are more like license ready, then we'll be more into the run-based business. And this is funny enough when we also see the highest impact then on the profitability. So we do believe that going forward, we'll see more or less the same picture, that run will be able to retain a higher margin than the build-based business. So in the last quarterly reporting, we talked into 4 different areas where we look into strategically in the midterm. So maintain high level of business development. I just talked into that, meaning we still see that going on here in 24, and that we keep investing in order to maintain growth. So this is still a strategy that we go into. And of course, that has a negative impact on the margins. So that's also why you see the updated guidance and what we just talked about before. It's really also about opening the US market, as Karen talked into. We believe in this, and we believe this is the right thing to do, and now is the right timing actually also to do it. Then, of course, we have an issue that last year we lost 2.7 million in our Inspire business. Of course, part of that loss was due to investment that we did because we thought, okay, now the world is moving upwards, and now we're ready to actually engage with the audience again, physically at bigger conferences. So part of that loss was really due to what we expected in 2023 in the beginning of the year, because we had a 22 ending on a high note and really, a lot of activity. But we ended up with a loss. And going forward to 26, we believe we can make that break even. We cannot do that yet in 24, but we expect to be roughly about minus 1.5 million in 24. So improving this by 1 million. Then we are looking into sharpening the business model in cyber protection. And we talked into cyber protection several times today. And I mean, we really believe everybody needs cyber protection. And we don't understand, why it's not super urgent on all companies' agenda. But it's not. It's not like super critical yet, but we expect it will be. So our challenge right now is that we don't have critical mass, meaning that we need to get critical mass as fast as possible. And we're investigating what opportunities that we actually have in order to get that critical mass. So one thing is that we are merging 2 of our business units together so that we have one larger unit instead. That's one way of doing things, and then collaborate internally to do that. But we're also investigating if there would be other opportunities to accelerate this even more. Then at the quarterly reporting as well, we talked into our own product development. And you have heard a lot of product names today. Francesco talked into even a new company founded as part of ESL, but focused on a product that is created and supported. And this is also something we see continuing. And when we do that product development, and if it's part of the Trifork core business, which is like the products where we can then, based on the products, make bespoke solutions to our customers, then it's also investment in organic growth that I talked into initially. So what we saw here in the first quarter of 24 was actually a 28% increase on the sales of our own products. As stated before, we believe that the historical development in 2022, we had a dip in relation to profit margin and run, but that was also where we invested heavily in new operation centers. So that cost the majority of the dip in 21. Q1 24, we also reported a lower EBITDA margin here, but overall we expect, as said, this to be at the top line in relation to profitability. Looking into the whole run sale of own IP, I just mentioned briefly before. Here you see more like the details. You see here Q1 23, there was a jump compared to the year before. And that was actually an acquisition of a company where we did have run-based revenue. So that was IB in Switzerland. And it was a little funny case because we already developed the IP that this company was running on. So that was developed by Trifork in Amsterdam. And this is actually now what runs the digital exams of the driver licenses here in Denmark. So that's the same software now resold once again into the Danish government. So when we picked this up, a large portion of this actually was based on inorganic growth. But as you see in the following here, is that we've been able to actually accelerate the growth in our own IP of own licenses. All looking then into inflation, into how workforce is constructed, all different countries, etc. How did that then pan out in Trifork? And if we here compare the number of FTEs overall to the average wages overall, I mean, you do see that in 21 we had the highest increase. 21, if you recall and go back a little step, that was super hard to find any employees to grow any company in the world within IT. So of course we were impacted that period by the same parameters as everybody else. But actually we've been able to level out, you could say, the inflations that then came in after COVID. So it hasn't had the biggest impact on Trifork overall. And of course, that's a combination of where we source talent, how we deliver. And as Francesco talked into, then now we have in many of our units, we have a very flexible delivery model and are able to work remote. So then again, EBIT for us, of course, is more or less like EBITDA, follow the same rules, regulations, I would say. But of course, when we're looking to the EBIT for the Trifork Group, then you have to take into mind that the 2 million euros that we annually invest in our lab segment, that gives an average over the same period here, gave a profit of 4 million a year in average. 2 million here is also included in the EBIT here. So then it's up to you when you look into the valuation of the company, if you take it in or not. We just explain how things are. But otherwise, EBIT is more or less following the same pattern as EBITDA for Trifork. That said, of course, when we do new acquisitions, we get a little more depreciations and amortizations to the acquisitions. So if we do more acquisitions, then we also expect a little larger spread from EBITDA to EBIT. So overall, coming back to the first slide here, we of course focus on net debt management as well. And as said, in the same period here, we did increase the financing with 23 million. And we did pay out 24 million to our investors. So of course, we could tell our investors, we should not have paid you out any money, and then we would be at the same level. But we still believe, and it's in our policy, actually to pay out dividend to our investors when when it's good for the company. And still, we have maintained the growth in the period at the level where we want to be, you could say. So right now, end of Q1 24, we have a debt to adjusted EBITDA leverage of 1.2. And this is including or not including any treasury shares that we have. And we still focus on the 1.5x in leverage, potentially go higher if we find the right targets. So behind this is what we believe is a solid development in the cash conversion. So of course, if we look into the operational cash flow, then we also have the investments that we do internally in product development, etc., that is used to organic growth in the company. It's included there, but not included when we see into the free cash flow from operations. But we believe that we have a healthy development in this area and prioritize to grow organic, but then next to that, the M&A. As said here before, if you look before the IPO, then we had a net debt of 37 million here, so 2.2 times our adjusted EBITDA. Then we did an exit of one of our lab companies. We took in some more capital, 5% increase of share capital in the IPO, and then we were net cash positive. And then over the years, as explained before, that was actually what happened, and now we are the same debt ratio, or debt again, with a 1.2 ratio. And now we're going to address some more targets. The targets here is targets related to ESG and our sustainability work that we do in Trifork. And I will hand over the word to Emilie, who is in charge of ESG initiatives in Trifork, but we support you 100%.
Yeah. Wow, I think it's amazing to be the ESG manager in a company where so many people are engaged in sustainability. I didn't count how many times sustainability or real impact was mentioned today, but I think it kind of supports my opening sentence, which is sustainability is at the very core of our business. It is not just something we do on the side. It is not just me doing sustainability in Trifork. We take both financial and non-financial factors into consideration. The non-financial factors is environmental, social, and governance. To have a holistic approach to how we work with sustainability or ESG in Trifork, we have 3 strategic pillars, which is finding greener solutions to how we operate, creating an inspiring workplace development, and equal opportunities for all, as well as ensuring responsible business information and ethics. So underneath our strategic pillars, we have some focus areas which makes it more tangible for us to work with sustainability. It is reducing our carbon footprint, ensuring a healthy and inclusive work environment, as well as ensuring compliance with CSRD requirements, a huge burden for a company like us. Yeah, so to reduce our carbon footprint, it requires real data. That's why we are investigating how to get the data directly. In our smart buildings, we have implemented devices that makes it possible for us to capture and follow live environmental data metrics. It is a really, really nice device because it can actually makes it possible for us to see on a very detailed level what is going on in the building. It makes it possible for us to change the behavior, to actually see how we can improve to a level where we can, after maybe a weekend, we see or observe, okay, there's been a huge amount of water going on this floor. Why is this happening? Then Søren from one of our smart buildings, he can actually go to the manager, or he can go to the room and see, okay, this might be due to a sink or something which is leaking, and then we can stop this process or this behavior, and that's a way for us to reduce our impact. The device also makes it possible to collect all this data to make more comprehensive sustainability reporting. Building on this foundation, we are exploring new ways to leverage technology to support and also to enhance our ESG and CSRD reporting. In terms of both quality, transparency, but also time efficiency. I think you might all know that CSRD reporting is not something done overnight. So if we can use our knowledge about AI and other kind of technologies to support this journey, it makes it possible for us to free up our human resources, me for instance, to actually go out and make the real impact. We believe that the real impact is not done through the reporting. Reporting is making the baseline. It's the way we can actually see that we are progressing, but it's not the impact which creates the difference in the world. That's the thing I need to do. I need to go to the different places. I need to go to our office spaces. I need to speak with our customers and our employees to be the one making the real difference. What did I want to say? So I just want to highlight that we are on a journey to make it easier to do our ESG reporting and compliance, focusing on optimizing our ESG processes or reporting processes using modern technology. So moving on to our long-term targets. We are aiming for a 70% carbon reduction in Scope 1 and 2 emissions by 2030. In our Scope 3, we will work together with our value chain to make sure that 70% of our suppliers have set science-based targets before 2026. On the sustainability or on the social dimension, we have set a target to achieve a 30% split of the underrepresented gender in our workforce and in leadership positions. At our board of directors, we have set a target of minimum 40% of the underrepresented gender, which we probably have already reached. I think Jørn already mentioned that, but we will work on maintaining this goal. On the governance side, we are working towards having all our suppliers evaluated based on sustainability principles to ensure overall responsibility in our value chain. Okay, so we are continuously learning and also proving that digitization enhances our life individually and also collectively. Together with our customers, we tackle everything from critical societal issues within the digital health sector to enhancing or doing CO2 emission savings through our technology, as well as enhancing biodiversity with AI technology. So in conclusion, we believe that Trifork's greatest impact comes from the solutions we create together with our customers as well as our partners. I think that's it. Thank you.
I actually have a little commercial then, Emilie. I know you are cleaning the beaches of Portugal next Monday. But the Monday the 10th, in this building at 5 o'clock, we're going to talk more about our robot. We're going to conclude our collaboration with Race for Ocean, which is an organization in the northern part of Denmark that cleans beaches on a regular basis. And we put some AI and robotics, and I don't know what technology, in this little turtle. And we're going to showcase that. So if you have interest in that, you're very welcome to come and have a look. Could be a new startup.
It could be.
Could be. Thank you so much.
Thank you.
Okay, Kristian.
Yeah, so now we're done for today. So now you can rest your ears a little, I guess. And before we release you to all the Vision Pro activities, then we just want to catch up here in relation to what we see as key takeaways from today. So one is that we acknowledge that we have a slow market condition right now, but I mean, we are still engaged to the future. We still believe in the future and still super excited for what to do in the future. We still see that we have a role as the pioneering tech partner to our customers, and we take that role very seriously. Not at least what we're doing in the US currently. And we really want to make a real impact, as Emilie stated here. It's not only what we do ESG in our own house, so to say, or with the buildings that we construct, but it's more what we can do actually for our customers in the whole agenda around sustainability.
Yeah, so just one thing to add about this execution part, because we demonstrated that we have the technologies, the services, the offering, we demonstrated those in market. And of course, the slower market means that you have to have many more leads, a pipeline that is way bigger. So we talk about internally that we need to have a pipeline 4 to 5x of the contracts we want to work on. That's a big difference to what we saw in 2021, where the pipeline was 0.2, because people that just came and asked for us to do something. So now we need to find talent that sees a huge opportunity in helping Trifork to just go and find work everywhere, be really switched on, be a hunter personality. And therefore also we have, and I say it to all the Triforks here, I say it a lot, that whenever you interview someone for a position at Trifork, you might look for a UX person or an Erlang programmer or whatever it can be. But 20% of all those should say yes to be able to wanting to take your job, Francesco, be the new CEO, kick you to pension, or me, or someone else. We need those young people, experienced people. We need them to come in and challenge us as the organization and want to take over and take the company to the next 1000x, as I talked to Karen about before.
Yes, and then maybe just to elaborate that we still focus on our teal model. Now including our lab companies, we're close to 100 units. We still want to drive that way more. And this is really what we see is working for us and the way to keep the innovation power in the company and to have that organization model. Okay, so I guess now we are open for questions. We have a microphone here to take questions, and then we have a panel here. So please go ahead.
Yes, thank you. Thank you for a great presentation. So the first question goes to the midterm targets, because this year the midpoint of the guidance implies a margin, EBITDA margin of 16% for this Trifork segment. Looking at the long term, you guide for 10 to 15% organic growth and a margin in 26 of 16 to 20%. So it could be a flattish margin, giving 10% organic growth. So should we assume if you only grow 10% over a 3-year period, you will not see leverage on the margins?
Well, of course, it's super hard to state anything about the development. And when you say this range, of course, we don't know exactly what to expect of the market development in the future until 26. So you could say the range that we have been giving, the 16 to 20%, is really slow market conditions. It's the low end, you could say. We still believe that from where we are in 24, where we believe that we do have hard conditions in the market, that we can increase the margins from there by 1 to 1.5%. So you could say anything equal, things staying as it is with the same type of conditions, we should be able to increase 1 to roughly 1.5% at least, even in those conditions. So So, and then of course you could say, okay, but if you accelerate organic growth, but you then expect then the margins to be lower, I guess that's what you're asking, right? But this is super hard to say.
Well, what we can say is that that we know the distribution of when you add growth and EBITDA margin. We know the distribution from our 100 businesses. So all the labs, all the Trifork segment business units, and it spans from being a negative sum, which is not nice, to way plus 100. Okay? So in fact, Kristian, if he was really brutal, he could actually engineer whatever number you want. Did you get that point? Mm-hmm. So, and then it comes into how much do we believe in something being a zero if you add growth and profit, and how much, I mean, if we could reduce everything and then we would be more than 100 if we just kept one business unit. We will be a small company, but it will be growing a lot and a high profit. So it's that mix. So there is some engineering into that and some decision making. And what Kristian said is what we will use as guardrails in making those decisions, what we keep, what we don't keep, what we deconsolidate, and what we consolidate. So it's not like just we are a leaf in the wind. We have a lot of control.
Oh, maybe.
Yep. A question to labs and exit policies. Thank you for the extra numbers, but if you take an average, simple average ownership of the top 10, then it's about 24%, 16% of revenue and 2% of earnings. So that's one way of looking at it. If you take the exits you had, you've done, at least you mentioned yourself too, where you did it too early, potentially. Humio is a core of CrowdStrike, and they've raised value by 500 billion DKK since you sold it. And they say they couldn't run the business without Humio. So my point is, if I take Dawn Health and do a valuation, pick a number, let's say 5 billion, and then I put in, say, buy Trifork because they own 3 or 4 companies with significant value. But I don't know if you're going to exit it in 3 months at a valuation of 600 million, if you think the job is done and you want to go on. So how should analysts and investors look at how do we get the maximum value out of these companies?
Yeah, so we learned a lot from the exits we did over time. There was also exits before 16 and good ones as well. So that's what I live from today. It's because of what happened in the earlier days. We did the first exit in 2004, a really nice one, and so we do have a lot of experience, and it's never looking the same. But I would say we basically follow the founders and the VCs, because that's the essence of a lab company, that we don't have control. We don't have 51% or 66% or whatever you need to have to maintain full control. So from now on, our guiding principle will be to follow the founders and the VCs. And then with the caveat that if it looks too good to be true, then we will probably take the money. But more towards follow the VCs and the founders. Okay? Does that make sense?
Yeah.
But of course, you should also look at this as a way for us actually to found, you could say, the organic growth in Trifork. So if we believe that we can actually do an exit and then use that in M&A, I mean, then it's a part of the, you could say, the dynamics in Trifork. This is also something that we do. So maybe you would call that an early exit. Maybe I would call it to hedge investments, and then actually use that in the organic growth, and then not have as high a leverage as we would have had otherwise. So it all comes together in the end, you could say. But of course, we all the time look into how to maximize the profit in the end for the shareholders.
A question on the US, which is obviously very exciting to grow revenues by 5 to 10 times. But what is sort of the biggest risk? What can go wrong?
I mean, so in the US, I think what you have more than anywhere else is the risk of lawsuits and that sort, So mistakes can have a higher consequences in general. That I would say is probably the main difference between Europe and US.
We're from SEB. Thank you for taking my question. I have 3. First question on the EBIT margin guidance. Kristian, could you confirm, is it organic or already reflect the dilution from potential acquisitions?
The guidance we gave here is based on organic. So not including the potential acquisitions, since we don't know the price, we don't know the depreciation model for potential acquisitions, etc. So that's based on that. So just saying my remark was more to that, depending how high you could say inorganic growth would be, then potentially there could be an impact here on the difference in between EBIT and adjusted EBITDA.
And next question on the Inspire business. You mentioned the basically expected to be break even by 2026. So how much revenue do you need to generate to reach that break even level?
I mean, that's a good question. And maybe it would not need to be a lot more than today, depending on how we organize. So we're looking into all parameters as it is right now in relation to, you could say, minimize the cost of running the operation, you could say, but still get the same benefits out of running that organization. This could also be in relation to actually, you could say, reuse resources in more than one way. So actually that we can do, without accelerating revenue that much. Of course, we do have some fixed cost in relation to, for example, our facility in London, where we have a code node as a space in the middle of London. And we're, of course, also looking into minimize cost, you could say, as the fixed cost in the organization there and make that more dynamic. So it will, you could say, cost would follow engagements more.
Yeah, so there are different things we can do. And we could also spin out Inspire as a lab company. That would be one way, because then we can maybe get funding for everything we want to do, because we think there could be more businesses interested in the insights that we gather in Inspire. It could also be that without a lot of investment, we can actually turn those numbers that we have, the views and the subscribers, into a revenue driver. There is also an opportunity for us being the matchmaker between communities and product companies. We expect there is around 10,000 product companies. That's a lot. Preben knows a lot of them, probably more than me. And all of those have spending in marketing and sales. And now they spend it on Reddit, on Instagram, on Google, etc. But it becomes a very blurry place. Whereas if we could create a more pure play for tech people, there's around 200 tech people that we could address. And if we could make 200 million tech people with 10,000 product companies, that would be pretty cool. So there is a lot of things we can do. But even with the revenues today, we could go into a break even.
And in relation to this topic, maybe a question to the board, because I heard there are some people from the board also in the room. I realized that in your remuneration report, a KPI for the management is the number of go-to channel, YouTube channel, clicks or reviews. I understand it is important to grow onboarding your main business and onboarding new customers. But in the last 2 years, we also see sort of this has been a main drag on the earnings, on the cash flow, and on the shareholder value. I was wondering, do you still see that as a proper KPI for the management going forward?
I mean, I'm not the board. I'm trying to convince the board what they should measure, and it's not like we are just wasting money to get a bonus from that. I truly, deeply believe that if we don't know what's going on in the tech world, Trifork is not Trifork anymore. We're done. So we have done it since the very, very beginning. Since '97, we have done this. It served us well. We would not have acquired Francesco and Erlang Solutions, nor other companies, Cedric, Spantry, actually no one. We would have acquired no one if it hadn't been for our Inspire. Because it's the orange people we like to meet. So the orange people meaning that subject matter expert that also happen to be an entrepreneur and a startup founder. So yeah, and I don't want the board just to say, oh, you lose 2.7 million, bong. And then next year, why don't you do M&A anymore? Well, because we don't meet people anymore. You know, that's not a good idea. So we do it from, you know, we want to be rewarded for what we really believe in.
But that said, I mean, of course, that number is one number. What we're really talking about here is thought leadership. It's really to, you know, embrace and to get the organization to react and collect information that way. So that's the point. And we are in discussions to you could say change that way of measuring, but then find other ways of measuring thought leadership.
What we could adjust is we want to be measured on that growth, but it cannot cost anything. You know, then you would probably be happy. I would also be accepting that. I would probably not get the bonus this year or next year, so be it. That's not so important to me. But I want to keep it, and I don't want it to be a drag on the company.
Makes sense. Thanks.
The one in the back.
Yeah, Mikael from ABG here. I have a question relating to your win rate, which you wrote was around 74%, but I guess that's a historical number, right?
Yes.
Yeah, and what about 2024 here? Has it been any lower?
Well, who was presented the number? That was you, Morten, right?
Yeah,
Oh.
right here.
Where are you?
Where am I? So that number is actually, it's pretty much up to date with what we've seen. I don't have the number exactly from January until now. I could find that easily and get back to you on that. The number is from probably September until now.
But what about Danish public projects? Has it been any lower there? Because the thing I want to get to is like, if it's any lower, is it because of quality or is it because of price?
So first, I don't think we can answer the question because that would be pure speculation. Yeah, but it's a good question. It's just hard to answer.
I guess so.
Yeah.
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 Okay, thank you. Henrik Ramlau, you mentioned that you had this ambition of revenue growth of 10 to 15%, and you had this, as an example, EBIT margin interval of 10 to 14% in 2026, and you also alluded to that you are in control of costs. So my question is, what does that lead to, perhaps in terms of an interval of earnings per share in 2026? Taking a reference,
earnings per share in
2026, referencing your 75 euro cents last year.
Yeah. So I mean, this we haven't done. You could
yeah.
say this is a target. So it's not a specific guidance in 26, but it's the target. So you could say growth and profitability, of course, are two different targets. And in the end, you would then calculate, do the math, and then you would have a span. But this we haven't provided.
Okay, so one color on that, because it also depends on how many shares we have. So
yeah, and that was my second question,
yeah.
whether you could risk being diluted by acquisition, so net, you would still be at 75 cents per share, euro cents.
Anything can happen. I mean, I I have probably been the one single person that has not been very eager to dilute my own shares. I held to more or less the same as I've had for many years. You know, remember, in the beginning it was 50-50. I had 50%, and we soon after, in the first 2 years, took in one more. I had 36, and then we did some primaries, etc. And so I believe strongly in the company. I'm not a huge fan of diluting my share, but I respect investors, analysts, if they say now it could be a good time to do some primaries, to do some more aggressive M&A, and if you can, you know, gear that, then it can be a really good thing. But that would be number crunchers as Kristian who convinced me if I should dilute, or if we should advise on all the shareholders to be diluted. But it could be a good idea, depending on the price and the share price and all that stuff. When it's not, and the price of money now, interest rates are higher. So there's a lot of factors into that.
But also, when you're talking about EPS, you also need to take the lab segment into account, and you know, potential exits from that, and what would the effect be there. So it's a really hard question to answer in that way, because you know, if you then take the average from the past years and do that as a prognosis for the next years to come, or if you think it's even more, because now you haven't seen the effect from maybe 2 years and development in some of those companies that we invested in, based on not being any external financing round in that period, right?
I think investors can adjust for that.
Yeah, just saying, you have a lot of moving targets in order to go that specific on EPS.
I can ask, if we would print 10% more shares and the revenue would grow 50% inorganic, would you say yes or no?
Depending on profitability.
If that was the same, you know, the company we acquire looks like what we already have. So that's the kind of considerations we need to look into.
But overall, as we do when also evaluating whether we should deconsolidate a business unit and then bring it into a lab company and you could say grow and accelerate, all of that are considerations that we do in relation to maximize the profit for the shareholders in the end. So you could say we do what we can, and we hope that we take the right decisions along the way.
Yeah, it's ready.
Oh, right. Wait again, from SB. Question on the potential exit of lab company. So let's see if there's any a company like Don Harris you would exit within the next 3 years. How do you use the proceeds? Would you prioritize M&A, or we should expect an increased shareholder payout?
Yeah, so I guess
I think there's an easy answer in the current environment, because if we see a nice M&A pipeline, there are companies that I want for sure, and if the valuations are reasonable, being what they have historically been, as Kristian said, they're getting back to that. And then my preference to and advice to everyone would be, use the money for that. Don't do share buyback and don't do dividend. Use the money for growing the company. It was kind of the idea with the IPO to 10x the company as soon as possible. So we should not delay that if we can use proceeds for that. That's, now you ask me, it's a personal opinion from my side.
Okay.
Great. Well, we have Preben here who has not said much, and so I'll throw a hard question his way. So yeah, iPhone came about, and many years later, the iPhone Pro came. iPads came. A few years later, iPad Pro came. MacBooks came. A few years later, MacBook Pro came. And instead, all of a sudden, we get presented with the Visual Pro. Why is that? Why have they come out with a Pro as the very first product.
You want to think for a second, because I have a quick answer. So while you think, okay, to give a really good answer. So Tim Cook was in the room when we were there in a very small group, and he said 7 years ago Vision Pro was 2 racks with a huge cable with a big screen, and in 7 years they managed to reduce 2 big racks with all the computer power you can dream of into something you have here. The Vision Pro is by far the most advanced device that I have ever seen with my eyes. And therefore also NVIDIA's CEO used it a lot in his presentation. He said, this is really impressive what they have done. It should not be possible. And of course, there has been a lot of cost, 2 racks. It's not just gluing existing components together. There were more than 5,000 patents acquired with developing the Vision Pro. Therefore, the Vision Pro is not just like another device. It is complicated, and the sweet spot is really for enterprise. That's why they start with that. Okay, and so it's also the first time Apple has done an event that stressed out the whole organization as much as the Vision Pro launch event that we attended, and our apps were shown at. It was stressful for Preben, for our team, for the 50,000 people in California, how many they are, Porsche and others. Everyone was really, they want to perform. You can give the real answer.
I didn't need all that time, because any reply that would be pure speculation. I see where you're coming from, and there are much speculation about this on the internet too. There's the developer conference coming up at Apple in 2 weeks. We might be closer to an answer.
Yeah, but the question was more, why the Pro first?
Yeah, but I mean, does that mean, could we see a community edition, a standard edition later on? It's pure speculation. No one knows. Yeah. But there might be a hint in a couple of weeks. Yeah. Yeah.
So, any more questions or comments? Nope. Okay, but then I guess we thank you all very much for coming. Now I guess, Frederick, we still have some. No. You don't have any mic. Okay.
It's done. Time is up.
Time is up. No. So now the ones of you who didn't have the chance to actually try out the Vision Pro yet, I really urge you to try it out, and then afterwards we need to talk. I have some ideas, especially for analysts and stuff like that. So we need to talk, but you have to try it out at first in order to get into your own mind what this can actually do in your own business, or maybe businesses that you know. And now we have, I guess, some drinks and some stuff over here. So welcome, enjoy. Thank you very much for coming.
Thank you.